Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Happy Friday, everyone. It is October 4th. We got the big jobs data here today, so we'll jump right into it. So here's the non-farm payrolls brought to you by the BLS, or Bureau of Labor Statistics, for the month of September. Previous month was 168,000. Forecast, again, I think we told you was 150,000. However, it came in a little less at 136,000. Now, that is a disappointing number because it did come in at forecast. However, the previous 2 months were revised upward of 45,000. So that brought our average monthly job creation at 157,000. So that was enough to satisfy investors, and you'll see later when you see the stocks why it'll be in positive territory. But this is not as bad as they made it out to be. The revisions is what helped out today's numbers here. Unemployment rate, as you can see here, 3.7. We forecast was remain at 3.7, and it came down to 3.5, and that was due to we got really high participation rate. It's actually like 63 and change percent, and it's probably the best we've seen probably like I think 6 years. What brought this down was that there's more job creation than what people came into the market. So we had pretty good size job creations, but there just wasn't enough people coming into the market to satisfy it, which is what brought the unemployment rate down. Now, here's the thing we really want to keep an eye on here is average hourly earnings. So we went from 0.4% increase in average hourly earnings in August to forecast of 0.2% September and basically remain unchanged. Now, this did bring down our yearly average down to about 2.6. I think it was at 2.9, brought down to 2.6. These are some, even though these job numbers look like they're okay, when we get in these recessionary talks, we're seeing this is what the analysts are looking at. They looked at the ISM. We saw the manufacturing are in contraction period. We're seeing a turn in the services industry, which is being affected. And then what they're going to do is they're going to look at the smaller components in the economic, or at least in the jobs, where first they're going to start looking at like hours worked. So what will happen typically is if it looks like we're getting into a recession, companies don't just lay off people right off the bat. They will usually cut hours, try to save money in terms of because the last thing they want to do is fire people, and so they'll cut hours, and so they're not having to pay out less. So they're looking at those, and then you'll see unemployment rate or the whatchamacallit, you'll go up. The initial jobless claims will start rising, and then of course unemployment eventually will fall into rising as well. So right now, of course, right now job numbers look strong, but usually that typically will be strong prior to a recession because we've already hit the bottom and then we're working our way back upwards. So these are just some components that we're looking for that possible or to predict when a recession might be around the corner. Sometimes it's a little bit late on that determining, but these are just kind of some initial clues we can look into. So let's kind of move on here to the headline news. As I indicated, the stocks are up. This whole week has been more or less data driven. They've been really looking at the data, as we mentioned earlier in the week. We had the disappointing manufacturing numbers. We had disappointing ADP number. They had the disappointing services numbers yesterday. So this whole week it's been down. Today with the revisions with the jobs numbers, it's upwards. Now today we do got a number of Fed speakers. This whole week we've had some Fed speakers, but the big one, of course, will be Jerome Powell, the Fed chair. He'll be speaking around 10 o'clock Pacific Standard Time or 1 o'clock East Coast time. They'll be listening to clues for him. They want to probably gauge as to what the next Fed meeting might be like, if what he'll be looking at, see what if he says anything about today's numbers or this past week's numbers. The wages should help create less inflation, so that might help us out with inflation talk that might lead them into possibly another rate cut. There's a lot of speculation about a possible rate cut this month and or possibly in December. So these are clues that they're going to be looking for, and it will be important to listen to him later today. So let's go ahead and move here, see how this is affecting the bond market. Bond market is up nicely. We're up about 11 basis points. Yeah, I would say we'd probably get some better pricing today. We're right up against the ceiling of resistance again, and right up on it actually, and trying to break above it. If we could break above it, we'll be right back where we were in the early part of September when we had some really nice rates here. and we'll have the next ceiling of resistance here. So again, nice movement here today. Pricing should be a little bit better today for mortgage rates. And yields, of course, have been dropping a little bit further. They got a little bit more room before they will hit their bottom. And right now they're sitting about 1.52, just a hair under. It's just rounded upwards at 152. All right, so the good news, mortgage rates look, pricing should be a little bit better today. All right, so if you guys are looking to buy or refinance, I'd love to hear from you guys. Please either direct message me or email me. I've helped out a lot of people out there from different solutions, from planning their mortgages. Most people think might be just give me a 30-year fix for the best rate, blah, blah, blah. But there are different things you want to think about from terms of economic standpoint, where we are, if 30-year fix may be best, or going with the ARM or different programs, maybe needing cash out or needing different things to try to figure out with your future of retirement. If you've got kids going to college planning, there's different things you might want to consider when you look into these. Because primarily the thing you want to look at is your debt, how you can control your cash flow on your debt and manage that into being able to obtain these other assets or these other areas where you want to improve in your life. And I can help you guys out with those. So just again, the best way to reach me is either email or direct message me. Especially email is probably the best way. But love to hear from you guys. You guys have a great rest of your day. Thanks so much for watching, and we'll catch you guys on Monday. Bye-bye.